Good morning, it's 10 o'clock, so we'll start our webinar. Welcome to our webinar this morning on the magic of management buyouts. This webinar will last about 45 minutes and there'll be time for questions at the end, so we'll be finished within an hour or so. What we're going to cover this morning is just a bit about ourselves, explaining why we're qualified to talk about management buyouts. And then Greg Barker, my colleague, is going to talk about the magic ingredients for an MBO, the magic of MBOs from a vendor's perspective, and then from a management team's perspective, a bit about funding management buyouts, and then I will come back in and talk about how we can help. And Catherine Gordon will then lead questions at the end. So please feel free to ask questions as we go along using the Q&A facility that's at the top of your screen or the bottom of your screen, depending on how you're viewing this webinar. And we'll pick up and answer, we'll try to answer all the questions that are asked at the end of the webinar. So just a bit about ourselves and why we're qualified to talk about management buyouts. We're a specialist team of deal makers. We've been going over 20 years, working together. The three of us have worked together over 10 years, and we believe in giving clients really the benefit of our experience in advising them on the best, as early stage advice on the best exit options. And we'll evaluate for many clients whether a trade sale or management buyout is likely to achieve their own aspirations. For many clients, we do trade sales, and for many clients, we do management buyouts, and it's roughly 50-50. Part of the service is really, as I say, early stage advice, providing valuations, explaining what can be achieved through either a trade sale or through a management buyout. If we're acting on a trade sale, we use powerful research tools to identify buyers worldwide. If we're acting on for acquisitive clients, we use the same powerful tools to identify target companies to approach worldwide. On MBOs, really, it's about setting off on the right path, making sure that the MBO that's agreed between the management team and the vendors can be delivered. So early stage advice, very important to make sure what is agreed can then be delivered. Advice on valuation, structuring the MBOs, what funding is likely to be available, how much will need to be on deferred terms, what sort of management equity stake is going to be required, and really giving that early stage advice to give clarity as to what the management buyout will look like and that it can be delivered. As part of the service, our main service is lead deal advisors. So once a client has decided on the transaction they want to undertake, taking them through that transaction from start to finish. And in the case of a management buyout, often, so I'll just kill my, got two phones going at the same time, I'll just kill my mobile. In the case of a management buyout, an important part of the assignment is fundraising in most cases, although we do a number of deals where fundraising isn't required because the vendor is providing effectively funding through deferred consideration. For certain businesses that wouldn't attract funding, a deal wholly using deferred consideration can allow the vendors to exit and allow a smooth transition to the management team. But for most of the deals we act on, fundraising is an important part. Negotiating deals, and as I said earlier, negotiating deals that can then be delivered is an important part of it, and project managing all the way through from start to finish to get the deal over the line. So we're involved from start to finish on a transaction and believe in starting it in the right way so it can be delivered. More than 20 years experience, and we see our strengths as our experience, our contacts with funders, our contacts with lawyers, our knowledge on how to get deals away, our integrity, our perseverance. There's always unexpected challenges on most deals, and you have to be persistent to overcome those. It's personal service, you know who you're dealing with throughout the transaction, and independence. We work, to get a deal away involves working very closely with our clients, with their accountants, with their lawyers. The team of different professionals working closely with the client is essential to get the best results. There's some of our management buyouts on that slide. There's more on our website, and the same photos are on our website and are clickable, which will tell you about any of those deals if you were interested. As I say, we've done many management buyouts, and roughly, when we're acting for vendors, roughly half the time, the trade sale path is the appropriate path, and roughly half the time the management buyout path is. We also act for management teams. So I'm going to pass now to Greg, who's going to take us through most of the seminar, and I'll come back at the end to explain how we can help. But as I say, if you've got any questions as we go along, use the Q&A facility, and we'll pick up those questions at the end of the webinar. Thank you.
Thanks, Andrew. Morning, everybody. So I'm going to kick off the technical content of this webinar by firstly looking at what we call the magic ingredients for a management buyout. And there's not really that many, and we find in most cases, businesses are suitable for management buyouts. The first ingredients needed is a profitable cash generative business. It's difficult to try and put management buyouts together for early stage businesses or loss making businesses, but most of the companies that we advise are profitable and generating cash. And that's important because it's the business itself that is going to be funding the management buyout, not the management team, and that's a key point which I'll expand on during the webinar. The second key ingredient is shareholders who are looking to sell their company, and far and away the most common situation we come across is where the owners of a business want to retire. Again, it's difficult to kind of make a management buyout happen where the owners aren't actively looking to exit. So usually we find it is retirement situations where there's a definite trigger event which it leads to a successful management buyout. And the third and final point is that there needs to be a management team able to take over the business and with that ambition to want to do that. And sometimes, the ideal would be a fully formed management team who've been running the business for many years without any involvement from the company owners. It's fairly infrequent that we come across those situations. In most cases, in SME businesses, the shareholders are actively involved in running the business, either as the main manager in the business or part of the management team. And that doesn't mean to say that a management buyout isn't possible in those situations. There's no need for the sort of management, the sort of incoming management team to sort of take over on day one. It could be that the vendors remain involved in a management capacity for a period of time after the transaction takes place, and that could last for several years whilst they gradually hand over management responsibility to the new shareholders. And sometimes that's also a big positive for owners. And a reason why they want to sort of go through a management buyout is that they don't want to exit the business completely on day one in a way that they might do if selling to a trade buyer. Often they want to remain involved in the business post sale, and a management buyout enables them to do that in many cases. I'm now going to go on to talk about why management buyouts can be a magic solution for vendors when they come to sell. The first reason is that a management buyout gives an opportunity for the shareholders to realise maximum value for their company. And that's sometimes sounds a bit sort of counterintuitive that a management buyout can achieve that because there's a sort of perception out there that trade buyers will always be able to offer more when they come to acquire a business because they can benefit from sort of cost savings and synergies that a management team wouldn't be able to. And sometimes, it is the case that trade buyers would be willing to pay what we call a strategic premium to pay over and above what a business is worth on a standalone basis because of those sort of cost savings and synergies available. But what we find in practice in most cases is that trade buyers negotiate quite hard on price, and that's because they will be taking on all of the risk associated with a company when they buy it, and the main way that they can mitigate their their risk that they're taking on is by negotiating on price, and making sure they pay as keen a price as possible for a company. Contrast that with a management buyout, and the dynamics shaping the deal are a lot different, and it means that the vendors can often achieve a higher price than might be achieved through a trade sale. They have in a management buyout situation, the vendors have quite a strong negotiating position when it comes to agreeing the terms with the management team. That's because they can control the timing. So it could be that if they're not happy with the price that's being offered by the management team, they could delay a sale for another year or two and benefit from the profits of the business during that time leading up to a management buyout. And therefore, often it's in the management team's best interest to go along with a higher price and do a deal sooner, because it gets them to that end position quicker where they've paid off the vendors and they can start to enjoy the benefits of ownership. And also going back to the point about risk, whereas with a trade buyer, they're taking on all the risk associated with the business. That's not quite the case with a management buyout. The managers, the amount of risk they're taking in respect of the transaction is limited to the amount of money they're personally investing into the deal, which might only be a very small amount of money in the context of the deal as a whole. And most of the actual deal value is being funded by the company itself, and so the risk really is falling on the unsecured creditors of the business. So that might be the bank if they're providing a cash flow loan, and more often than not, the main unsecured creditor is the vendors themselves after they've sold the business, because they would have part of their consideration paid on deferred terms, and there would be an unsecured creditor. So a lot of the risk remains with the vendor in a management buyout, and because of that, they're in a stronger position to negotiate the price that they want for the business. So just leading on from that point, the next sort of feature of a management buyout, which can be attractive for vendors, is that there's an opportunity to reinvest part of the sale proceeds back into the company and make a better overall return for them. So I mentioned that in most management buyouts, there's a requirement for vendors to receive part of their consideration on deferred terms, which might take several years before they've received all of their money from selling their shares in a company. That's often seen as the major downside of management buyouts, in that vendors have to wait a length of time before receiving their consideration in full. But the flip side of that is that there's an opportunity to view the deferred consideration as an investment and get a high rate of return on that investment. And often that's not that much of an issue if the owners of the business have already put enough away for their retirements and have a significant amount of cash paid out at completion of a management buyout. Then often they're looking around for ways to reinvest the money anyway to give them a good return, and what better place to reinvest your money than in the business that you've grown and managed for several decades and know inside out. And I'm going to take you through an example on the next slide as to how that might look. So this is a very sort of simplified example of what a management buyout can look like, featuring deferred consideration. So let's say that there's a company which is sold to its management team for £3 million. Let's say a bank provides just over half of the funding for the deal. The management team invest £150,000 between them for 75% of the company, and the balance of the money, 1.15 million, is reinvested back into the deal. Most of that is on deferred terms to be paid from the future profits and cash flows of the business, and and then the smallest small proportion of that, let's say £50,000 in this case, is invested into share capital in the new holding company on the same terms as the management team. So overall, the new holding company would have £200,000 of equity, 75% of that owned by the management team, and then the exiting shareholders would reinvest for a 25% stake in the holding company. So in this example, the vendors receive a very substantial amount of their value in cash at completion, funded by largely from the bank. And then they receive further payments totaling £1.1 million over the next few years on deferred terms. So they receive all but £50,000 of their £3 million value over that period of time. Once the bank has been repaid and the deferred consideration has been repaid, and let's assume the business doesn't increase its profitability during that time, and at the same time doesn't reduce in value, it's still worth £3 million in 5-6 years' time once all the debt has been repaid. Then the value of that 25% shareholding in the new holding company would be worth £750,000. And therefore, the total amount of money that's been paid to the vendors would be £3.7 million, which is a 23% premium over and above the £3 million deal value. So you can see this sort of simplistic value example that there's a fantastic opportunity for vendors to get a lot of cash out at completion of a management buyout, but then reinvest part of their proceeds and get a much better overall deal over time. The third sort of magic feature of management buyouts for vendors is that you know who you're selling to. There's no need to go out into the market and speak to lots of different potential buyers and trying to find somebody who's got the same sort of values and somebody who you trust to sell your business to. You know the people you're selling to. In most cases, the management team will have been in the business for many years and have developed a strong relationship with the business owners. And with any sort of deal like this, trust and goodwill are essential. So having somebody on the other side of the deal who you get along with and trust is vital. Because you already know that the parties involved, the transaction can be a lot smoother from start to finish. You can get into negotiating the deal much quicker rather than a period of time of sort of getting to know somebody. The management team will already know all about the business, so there's much less of a fact-finding process to go through on the part of the buyer. The due diligence requirements would be much reduced compared to a third party buying the business. And you can avoid the potential difficulties of speaking to competitors or other companies in your market and risk industry gossip spreading, which might be a problem if going out into the market and looking for a trade buyer. With the management buyout, everything's kept in-house. There's no need to go out and talk to other companies in the market. And even if a word of a management buyout does get out to customers or other staff within the business, it's much less likely to be an issue compared to a rumor spreading about a company being on the market and for sale. Also, in many cases, there's no desire to go out and find a third-party buyer for a business at all. We advise on many family businesses and take them through management buyouts where there's a need to transfer equity ownership from the older generation in the family to the younger generation who want to take the business forward. And a management buyout is can often be a much better way of doing that rather than waiting for shares to be passed on in inheritance, which can obviously take quite a long time and lead to issues. The fourth attraction of MBOs for vendors is that there's an opportunity to secure legacy, and legacy is a word that crops up time and again when we talk to business owners about what they want to achieve through selling their business. And it's often, it's not just about the money and getting best value for their shares in a company. It's also soft factors are often equally important. So it's things like wanting to see the business remain independent in the future, rather than being absorbed into a larger group and losing its identity. Business as usual, so there's not going to be any sort of disruption to the business and major changes in how it operates because it's going to sort of be simply it's going to sort of remain as it is, and the management team are not going to be making any drastic changes compared to what might happen with a trade buyer. There wouldn't be any risk of any sort of major reorganisation or job losses, again, like you might find with a business that's taken over by a larger trade buyer. And also, management buyouts are often a fantastic way for the business to be sort of re-energized and sort of move forward at a quicker rate under its management team. Often we find situations where a business where the owners of a business are happy with the level it's reached, and it's generating a good income for them, and it suits their lifestyle, and they don't want to put too much more time and money into growing the business further. In those sorts of situations, a management buyout can allow the shareholders to retire and get full value for what they've built. But at the same time, it allows the management team the control over the business to reinvest profits back into the business and look to grow it at a faster rate. So it can be a catalyst for the business to move forward. And as I've mentioned at the outset, with the management buyout, there's an opportunity for the vendors to remain involved with the business after they've sold it and have some influence over how the business develops in the future. So often you might find if the vendors perhaps reinvest part of their proceeds for a minority shareholding, they might remain on the board, maybe as a chairperson or non-executive or an ambassador for the business, and still have that ongoing link to the business, rather than a sort of a clean exit and not have any sort of further involvement. Another reason why management buyouts can be a magic solution for vendors is that quite often a trade sale is impossible. And this goes back to risk again. With a trade buyer, they're taking on all the risk associated with the business when they buy it, and those key risks might be reliance on key individuals for management of the business, perhaps an undue amount of reliance on one or two major customers, or a lack of visibility over future sales. And sometimes those risks are insurmountable for a trade buyer. If there's a business that's reliant on one or two customers, they just aren't willing to take that risk that one of those customers looks to move away as a result of the change in ownership. And therefore it just means that a trade sale is a non-starter. Because the risks are shared in a different way with a management buyout, it doesn't mean that those same risks would rule out an MBO transaction. So if it's a company where the key risk is reliance on one or two key managers, then again that's not a risk with a management buyout, because it will be those one or two managers actually buying the company. If it's reliance on one or two major customers, the management team would be the people with those relationships with those key customers. And because it would be business as usual, there'd be no reason why those customers would need to go away as a result of a change in ownership. And the management and the vendors are best placed to understand those risks. If it's a problem about visibility over future orders, that can be very difficult to get a trade buyer comfortable over. But if it's the management team and the vendors sort of sharing that risk going forward, they'll understand the risks fully, and a deal can usually be structured that can allow those risks to be overcome. And I think this is the final sort of benefits of MBOs for vendors, is that a management buyout can be controlled to a greater extent compared to a trade sale process. With a trade sale, you can do some work at the outset to understand what level of deal activity there is in the business, whether there's any major risks in the company that might make a trade sale difficult. So you can do that early stage analysis, but even after you've done that, you never really know what level of interest you're going to get from potential trade buyers. You don't know exactly what sort of offers will be forthcoming. So it can be an open-ended process where you don't know what's going to be achieved at the end of it. In contrast to a management buyout, the vendors can plan in advance what a management buyout would look like, how it would be funded, and make sure they're happy with the overall shape of the deal before it's presented to the management team. So you can have a great deal of certainty over what the outcome is before you actually set off down the road with a management buyout. It allows the vendors to decide on the timing of a sale, and they can have a lot of flexibility in terms of whether they retire from the business in a phased manner, or whether they look to exit completely when the management buyout takes place. And it can also help tie in key members of management leading up to the point of sale. So if a management buyout is planned well in advance of when it's going to take place, and it involves the management team, they know what they're working towards in the medium term, then it can help sort of tie them into the business rather than risk those individuals leaving and joining a competitor perhaps. So I've talked at length about the various attractions for management buyouts from the point of view of vendors, but management buyouts can be fantastic opportunities as well for managers looking to acquire their employers. And the main reason for this is what's called the gearing effect, and that is that the purchase of the business is funded by the business itself through the business taking on debt to pay off the vendors of the company. And as the company pays off that debt over time, the equity value that belongs to the management team increases. So this bar chart on this slide aims to illustrate how this works. So at year zero, when the management buyout takes place, again, let's say the business is bought for £3 million. Almost all of that £3 million would be raised through debt. So this might be bank loans and deferred consideration owing to the vendors. And then you've got a small amount of equity, being the £200,000 invested by the management team from their own resources. And then if we look at what happens to the debt equity profile over a 5-year period, you'll see that as the company makes profits, it repays the bank, repays the deferred consideration owing to the vendors, and then usually over that sort of time scale, all of the debt can be repaid. And even if the company value remains at £3 million, that would be the equity value for the shareholders, and their original £200,000 investment would have increased sort of 15-fold to £3 million by the end of that time period. So because that's such a huge sort of increase in value, it means that the price that's being paid for the business is you can be flexible over the price. The second sort of attraction for managers is that an MBO gives an opportunity for them to take control. Often they might be in charge of day-to-day management of the business, but not have that level of control that allows them to reinvest in the business and grow it at a faster rate. I've mentioned that vendors quite often are not wanting to grow the business too quickly and would rather sort of take more cash out of the business. A management buyout gives the management team full control. They can dictate the strategy of the business going forward and help to grow it at a faster rate. And a management buyout also helps managers to secure their long-term future. They've moved from being a salaried director to a business owner, and they have sort of full control over their destiny. And finally, an MBO is truly a once-in-a-lifetime opportunity for individuals to transform their personal wealth. It doesn't happen overnight. As I mentioned on the previous slides, it might be a 5-year time period whilst the business is paying off debts to the bank and the former owners. And during that sort of that short-term period, there wouldn't be any opportunity for the managers to take dividends and start to enjoy the benefits of ownership. But during that time period, it might be appropriate for them to take a larger salary if they've needed to take out personal loans in order to fund their initial investment in the management buyouts. And if they're taking on more responsibility through promotion, it might be appropriate to take a higher salary during that 5-year sort of timescale. But at the end of that 5 years, in the long term, there's an opportunity for the management team to declare dividends and enjoy the benefits of ownership of the company, continue to grow it, and in the long term look to sell the business themselves. So there's a fantastic opportunity to completely transform wealth from being a salaried employee to being a business owner. Just finally, before we sort of move on to how we can help, I'm just going to talk very briefly about how management buyouts are funded. And I've mentioned several times that it's the business that funds the management buyouts, not the management team. Most management buyouts will be funded through a mixture of those 4 different types of funding, which I've outlined on this slide. The first being asset-based lending, so this being lending products offered by banks and specialist lenders where there is full security available to the lender. So typical examples would be invoice finance facilities, stock finance, plant and machinery loans, property loans. And that's normally the first place to look when it comes to securing funding in support of management buyouts. Because there's full security available for the lender, it's fairly easily obtainable finance and fairly inexpensive. The amount of asset-based lending that's available depends on the nature of the business and what the balance sheet looks like. But even if it's a business with a strong balance sheet and there is plenty of asset-based lending available, often that still doesn't go anywhere near enough to funding a management buyout in full. So we need to look at other options as well. The second type of bank lending available is cash flow loans. So this is your sort of traditional bank loan where you've got a set amount of debt that will be repaid over a period of time. in instalments. The availability of cash flow loans depends on the size of the business, the level of profits, how the risk profile of the business. So for smaller, riskier businesses, that might not be an option. But for larger businesses, there are plenty of banks and alternative lenders who actively seek out management buyouts and aim to put cash flow loans in place to help support them. And then the third type of finance is deferred consideration, which we've talked about this morning. And in our experience, most of the management buyouts that we act on involve an element of deferred consideration or vendor finance as a way of making the deal stack up. So even if a management buyout is attractive to banks, they might only be able to lend, say, half of the overall deal value because they want the risk to be shared rather than the bank taking on all of the risk associated with a transaction. So you might find that maybe half of the deal value is paid on deferred terms through vendor finance. And the final option on here is private equity. So again, this might not be applicable to all companies. Private equity tend to target businesses with clear growth potential, where the business is already of a certain size. So typically they might look for businesses that are already making $500,000 EBITDA or 1 million EBITDA as a minimum. And there's a strong management team and a strong business plan that the management team can put forward to grow the business quickly. So the private equity investor can be confident of making a good level of return on their investment when they come to exit in a few years' time. So the mix of those different funding sources will vary from company to company, and it just completely depends on the circumstances of each particular kind of business. And as I've mentioned, it's important the funding structure shares the risk equitably between the different parties involved, the bank, the vendor, and the management team, and it's the management team. They'll need to put in some of their own money, and that's important because they should be taking some of the risk. But overall, most of the risk is going to be shared between the bank and the vendors. And finally, there's what we call hurt money. So this is the personal investment that's coming from the management team. And as I've mentioned a couple of times, it's a relatively small amount in the context of the deal, but it can still be a very significant sum for the individual concerned. It might, if for a bank-sponsored management buyout, a bank might require that managers invest an amount equal to sort of 1 times their annual salary. For other kinds of deals, that requirement might be less. But it is a lot of money for managers to come up with. But because of the gearing effect, it's often a fantastic investment for them to make. And I'll hand back over to Andrew at this point to just talk through how strategic corporate finance can help advise business owners who are sort of thinking about a management buyout. Thank you.
Thanks, Greg. Just a reminder, if you want to ask questions, we're going to go into questions in a couple of minutes' time. Please use the Q&A facility at the top or bottom of your screen, and we'll pick up on those questions, as I say, in a couple of minutes' time. Just really how we can help on MBOs. As I said right at the start, we've got a lot of experience of advising on MBOs. Been advising on MBOs myself for over 30 years. And for many clients, it is the right approach, providing you've got the key to a management buyout is really having people in your management team who are capable of running the business, capable of taking the business forwards, and are comfortable with the ultimate responsibility of ownership. We find many circumstances where the management team are great at running the business day to day, but just don't want to take that ultimate responsibility, quite like having shareholders above them who ultimately are responsible and can be spoken to when key decisions are being taken. But as Greg said, one of the beauties of an MBO is that the vendors can continue to be involved, either on the board or in an advisory capacity, and can retain equity if that's appropriate as well. So you can have a very smooth transition, making the passing on of ultimate responsibility a smoother transition over many years. Our services, we really like to start at an early stage, as I said at the beginning when I was introducing who we are, to advise clients on what can be achieved, what is feasible. Over the years, we've seen too many deals where company owners and the management team have negotiated a price and a deal structure before taking advice that can't be delivered, and have tried for months and months and months to obtain funding and to deliver the deal structure themselves when it had no realistic prospects of being delivered. And that can actually cause relationships to break down, which were strong before between the owners and the management team, and mean a management buyout just won't take place. So really early stage advice. We do a number of MBO feasibility reviews every month, advising our client, which can be the owners, and often is the owners. Often we find the success rate of a management buyout is higher if the owners have initiated it or indicated to management that they wish a management buyout to take place. But the feasibility review includes a detailed business valuation. We get under the skin of the business. We understand the business in detail to give our professional view on the business valuation. And our professional view is based on many, many, many years of carrying out MBOs and many, many years of carrying out trade sales and seeing different offers put forwards for clients we're selling. We'll also use our experience of funding MBOs and talk to our funding contacts often when doing MBO feasibilities, where we're not confident on what funding might be available, to set out the funding options and what can be achieved. Obviously not guaranteed, because it's a big process, a long process to go through with certain types of funding, particularly cash flow loans. But our funding advice will be fairly accurate and give a good indication of what can be achieved. We tend to be slightly cautious, so same on the valuation. We'll be slightly cautious on the valuation, slightly cautious on what funding options can be achieved. When we get into the deal, if we can push the valuation up or down, depending which side we're acting for, and achieve a bit more funding, so much the better. We'll set out the MBO deal structure, so how much can be funded, how much management team are going to need to put in, how much will need to be on deferred terms, when that deferred consideration can be paid, and we'll give advice on the process to follow to deliver the MBO. And if appropriate, if we're acting for the vendors and they want us to compare what can be achieved through an MBO with what can be achieved through a trade sale, we'll give that comparison. And as part of that comparison, we'll set out what deals have happened recently in their sector. We use subscription databases that allow us to see what deals have happened worldwide over the last few years. And that's a particularly useful tool for seeing if there's been acquisitive corporates out there that acquisitive time and time again and indicate there's a good market for trade purchases in that sector. But really the purpose of the MBO feasibility is to give clarity over what an MBO would look like and what can be achieved, to help with decision making as to whether that's the right route, whether now is the right time, and to make sure that when the client does start the process, it can be delivered. Our main service is lead deal advisory service. So once the client has decided to go ahead with a transaction, it's taking the client from the start to the finish of that transaction. So making sure that we negotiate the terms of the deal, they're fully documented, usually using heads of terms. So there's no misunderstanding later. The heads of terms are a good document for briefing funders, a good document for briefing lawyers, a good document for briefing tax advisors. So ensure there's clarity as to what the deal will be. Where fundraising is required, which it is on most deals, we'll prepare the business plan in conjunction with the client and forecasts. The client needs to take ownership of that document and believe in that document and the forecast, and be able to talk to funders and answer questions and justify the positions taken. We'll introduce the client to appropriate funders who we believe have the appetite to support their deal. We'll attend those meetings and we'll give advice on fundraising options. And we'll work with, as I said at the start, we work very closely with solicitors, tax advisors, accountants, and clients as a team to bring the MBO to completion. So it's quite a long process. It typically takes 9 to 12 months. It can be quicker. Certainly fundraising isn't required. It can be quicker. We have delivered recently some MBOs in record time. We completed 3 management buyouts in the week before the budget that took place in March 2021, because there was an expectation the capital gains tax rates were going to go up, and an expectation they could go up significantly. So we got 3 deals away, which we managed to drive through in record time by the funders ourselves and the lawyers having a firm deadline and working quickly without cutting corners, because you can't cut corners with funders, to deliver those deals. So we enjoy doing what we do. It's very satisfying, and it's very satisfying for vendors usually to see the management team that have worked with them helped create the wealth that they're now realizing, get the opportunity to take the business forward, and often with vendors giving some ongoing support, but on a part-time basis. So we're going to move now to questions. I'm going to ask Catherine and Greg to come back on. Catherine will take us through the questions, but it's not too late. If you want to ask a question using the Q&A facility, please do so. Catherine, what questions have we got so far?
Yeah, I've got a couple so far. Morning, everybody. The first question is, where a vendor takes a shareholding in the new holding company in an MBO, is entrepreneurs relief still applicable?
Okay, that's a good question, and we're seeing major changes at the moment in our expectation as to what will happen to entrepreneurs relief and what will happen to capital gains tax. Entrepreneurs relief was renamed by the government a few months ago and is now called business asset disposal relief. But effectively, it's still the same thing. It still gives vendors a 10% tax charge on exit, but the lifetime limit has been reduced from £10 million to £1 million. So a vendor who is selling their shares for £2 million and has not used entrepreneurs relief in the past will get the first £1 million at 10% and the second £1 million currently at 20%. We're expecting capital gains tax to change and rates to go up, and we're expecting the business asset disposal relief possibly to be linked to retirement age, as it was many years ago with retirement relief. And our expectation for that is because the government, or it was actually the Office for Tax Simplification, was requested by the Chancellor of the Exchequer to advise on capital gains tax and whether changes should be made. And they issued a paper in November last year, November 2020, which looked at all different aspects of capital gains tax, from whether the annual tax-free exemption, which I think is currently £12,300, should continue, whether entrepreneurs relief, which is now called business asset disposal relief, should be linked to retirement age, and whether it is appropriate for there to be such a massive difference between the tax rates on selling your shares in a private company for millions of pounds and the tax rates had you taken dividends out from the same company should be so different, with tax rates of 10% under business asset disposal relief, 20% if you don't qualify for that, compared to 40-odd%, or at least certainly 30% plus on dividends. And there is an expectation now, based on that paper and the recommendations it gave, or the suggestions it gave, that there will be a narrowing between the capital gains tax rates will go up to be closer to income tax rates at some stage, probably the next budget. And the government's the budget red book that's issued after the budget each year, showing tax revenue for the next few years, shows capital gains tax income for the government increasing by more than 50% over the next 3 years. So it's not just about entrepreneurs relief. Yes, a vendor who has sold their shares and taken retained equity, providing they still qualify for business asset disposal relief, which essentially means a 5% shareholding with the rights 5% rights attached, 5% on winding up, 5% of dividends, 5% of votes. And if they continue to be an officer or an employee, they will still qualify for what was called entrepreneurs relief. But that relief may change in the next budget. And they may have used their lifetime limit of £1 million up on the first deal and therefore have nothing left on the second deal. So the answer is we'll have to wait and see what happens in the next budget, really, because I'll be surprised with the Chancellor having asked the Office for Tax Simplification to look at CGT, and their discussion paper is fairly compelling in some of the arguments he makes. I'll be surprised if there aren't changes once businesses have recovered from COVID.
Okay, thanks, Andrew. Got one other question. So if there's anything else that anybody wants to ask, please do so using the Q&A box on your screen. The question we've got here is, do MBOs work with a service-based business that has few assets?
Greg, do you want to take that?
Yep, absolutely. I think service businesses can lend themselves well to management buyouts. I talked about the different types of finance available, and yes, if it's a service business that has sort of few tangible assets on the balance sheet, then it probably wouldn't be suitable for asset-based lenders, and if they're providing a service, again, invoice finance probably wouldn't be an option. But if it's large enough and there's sort of predictable sort of cash flows and profits, then term loans ought to be a possibility as a means of raising bank debts towards a management buyout. Deferred consideration is something that can be applied for any type of business, including service businesses. There's no reason why management buyouts wouldn't work for service businesses. It sort of comes down to the strength of the management team. If they are the key people in the business, and the vendors are willing to back them and have faith in those individuals to take the business forward and provide financial support through deferred consideration, then there's no reason why a management buyout can't take place in those situations.
Thanks, Greg. We've done loads and loads of service-based business MBOs over the years, and they're not really viewed as any different to any other type of business. As Greg says, it's down to the fundamentals of management team strength and profitability, and what the business does. So have we got any more questions, Catherine? Or
no, that's it. No more questions, Andrew.
Okay, thank you. If you do decide you've got a question, Catherine's going to send out the slides later today or tomorrow. And if you have any questions, just ping a question back to that email. Thank you for listening. If you would like to have a chat about your business, or we've got a number of accountants and solicitors on the webinar today. If you would like to have a chat about how we can work together, please do get in touch. We'd welcome the opportunity to talk to any of you, and thank you for listening. We've got other webinars coming up over the next few weeks, less over the summer, 6 weeks, but we still have got one late August. But please go to our website, strategiccorporatefinance.co.uk, if you're interested in other webinar topics such as valuations. We do one on comparing and contrasting a trade sale with a management buyout. Please feel free to book on future webinars. Thank you for listening today, and we'll bring the webinar to an end at this point. Thank you very much.